Most investors think you take huge risks if you're going to be a billionaire, huge risks to be really successful financially. The truth of the matter is these great investors do not take those huge risks. The vast majority do not. Asymmetrical risk reward means they try to do the least amount of risk possible with the most upside.
What's going on, investors? AK from Fallible here. And as you just saw in that clip, our favorite performance coaching mini trampoline jumping giant, which if you haven't seen him jump on his mini trampoline, definitely check it out because it's pretty funny. But Tony Robbins is talking about an extremely important concept here. And this market concept is asymmetrical betting. And I know, like, most of the time you want things to be symmetrical, right? For example, like in interior design, which as you can tell by this gray bland room is something I love to do. Or say for maybe even your face, which you want to be symmetrical because if it's not, then you'd have a crooked face. And people would make fun of you, but at least you wouldn't need a mask on Halloween, right? But in the markets, asymmetry is the magic word that everyone is trying to achieve. And this asymmetry is not only important to make a ton of money, but it's also extremely important to make sure you don't blow up your account. And that's exactly what we're going to talk about in this video. Here's an example Tony gives of the market wizard Paul Tudor Jones and how he places asymmetric bets.
He would look for investments where he didn't want to invest unless he believed if he invested $1, he could ultimately make 5 off that dollar, 5 to 1. Now, he knows he's going to be wrong lots of times. And so he knows if I risk $1 and I lose, I can risk another $1, I'm still going to be up 3, you follow? He could be wrong 4 times out of 5 and break even still. So that's the secret.
See, a lot of investors are all focused on the upside of the trades that they put on. But what is way more important than the upside is the downside. That's what you need to be focused on, and asymmetry lets you actually cap that. See, the thing about markets is that the complexity embedded within them is infinite. There is no way to understand every little thing going on. And even the best investors, the masters of the universe like Paul Tudor Jones, accept that. It's like that old saying, you know, a wise man knows what he doesn't know, which actually wouldn't be too bad of a pickup line, would it? They say a wise man knows what he doesn't know. And girl, I don't know, but I would love to know your Instagram. And maybe it's not that good of a pickup line, but if it works for you, make sure you give me all the credit. And tell whoever it works on to subscribe. But yeah, the best investors focus on asymmetry because they want as much leeway to screw up as they can get. They want the ability to screw up a bunch of times but still make a ton of money. Basically, if they were bowling, they would put up those little bumper lanes. A lot of successful strategies have a win rate percentage of only 30%. Like for example, Peter Brand, another legendary trader, his win percentage is right around there. But even when they win so little and they're losing 70% of the time, they're still making a ton of money. And that's because when they lose, they only lose a very little. But when they win a whole lot. And this asymmetry gives them the ability to just take a beating in the markets and still come out ahead. And you really got to understand how important it is to cap your losses. Because once you dig yourself into a hole, it's pretty tough to get out. And I'm sure you know the example. Say you have $100 and you lose 50%. So you're at $50, right? But how much does it take to get back up to that 100? It's not a 50% gain again. This time it's 100% gain. And that is in no way easy to do. So when it comes to the market, you always want to be playing defense. Your number one priority is to cover your ass. The worst thing that can happen is you taking a loss that you can't recover from. Tony gives us another example of a billionaire investor using asymmetry, and this time it's through Kyle Bass.
Kyle Bass took $30 million in 2008-9 during the worst economic time in history and turned into $2 billion in 2 years. How the hell do you do that? He never risked more than 6 cents to make $1. If he's wrong, he'd be wrong 15 times and still make money. Well, he wasn't wrong 15 times, which is how he turned 30 million into 2 billion.
Okay, so how do you know if your bet or trade is asymmetric? Well, that kind of depends on your strategy. So if you have a discretionary trading strategy, then it comes down to research and conviction. So in Kyle Bass's case, he had an entire team doing a ton of research on subprime mortgages. And after doing all that research, he was absolutely convinced that a collapse was coming. And a collapse of that magnitude will give you the asymmetry that you want. And this is how a lot of the macro guys work. They're looking for outlier events, because when these events come along, and they don't come along often, you get a chance to bet very little and make a ton. But it's not an easy thing to do. It takes a ton of research, and you usually end up placing a bet that no one is with you on. They all think you're stupid for doing it. You end up being a contrarian. And it's not only that, but with these once in a lifetime events, they get extremely volatile. So it becomes real tough to hold on to your position. And that's where that conviction plays in based on all the research you did. And in general, you just need really big bucks. balls is not easy. And that's why I prefer the easier route with a systematic strategy, because then you have a nice set of rules with the same trades being taken over and over again that you could backtest. And through that backtest, you could see what your average win is and what your average loss is and see if that's asymmetric or not. And if it is, you keep running that strategy. You don't have to depend on yourself to call some huge macro event out in the future. You don't have to worry about whether your research is right or not, or whether all this work will finally pay off. And with all this knowledge of a backtested system, it's a lot easier to hold your positions through the volatility. You can just have average size balls and you'd be okay. Now, if you're interested in more videos like this where we dissect investing concepts like asymmetry, then make sure you subscribe to this channel and hit that bell for notifications of new videos. We do about 3 a week and you don't want to miss them. So subscribe and I'll see you in the next video. Stay fallible out there. Bye.